What's going on, guys? In today's video, we're going to take a look at the most popular high dividend ETFs, and we're going to also take a look at the international options if you want some extra diversification, emerging markets as well, some low yields and higher yield ones, and Canadian equivalents to these for my Canadian fellows. And of course, I'm going to talk about performance comparisons while taking a look at some charts as well. Let's start by defining what is popular. What I'm going to go with is the assets under management. Basically, it reflects how much money investors are willing to pour into these funds. So the trust level that they have towards the managers. And we're going to take a look at the three most popular options out there that I think offer great diversification, even though there's some overlap, as we will see. Going by assets under management, VIG is the most popular one with $98 billion under management. SCHD, 68 billion, and VYM at 65 billion. Looking at costs, the expense ratio is very low in all cases. VIG having like a 0.01% advantage over the others, but this is very insignificant. If I was to invest in each of these stocks equally, I would get exposure to 25 different stocks and percentages. There is 5 overlaps that I can count in the top 10 really quickly, but it still gives me a very good diversification into high quality dividend stocks that would increase their dividends over time. So even if I was to go with the strategy that I will explain later in different videos about covered calls, if I invest in some of these stocks, I would buffer the NAV erosion that I would get by investing into covered calls, but I'll touch on that in future videos. As far as sectors, you can see here that SCHD is a bit less invested into the financial sector, a bit less into the electronic technology, and a lot less into technology services. So you can expect a bit of a variation in performance depending on the market cycles and where people try to invest their money. Right now, AI and technology is the craze. So I expect SCHD to perform a bit less because right now energy minerals are not very sexy. So you have to take that into account, but it's part of the diversification. Another caveat regarding diversification is the countries they invest in. These are very United States centric, so you need to have a broader diversification, in my opinion, if you want to not get slaughtered if ever there's something big that happens in the United States. Now let's take a look at the dividend yield and the dividend growth rate. If we look at the VIG, it has a 1.65% yield, which is not very high. And it pays quarterly, but it's been growing its dividend annually at a steady rate. So I expect this to continue over time. If you look at the dividend yield in the last 10 years, it's at a pretty low point right now. All these little spikes are when the market crashes. So if you're interested into dividend investing, sometimes it's a good point in time to invest in those if there's a market panic or something like that, because these tend to recover quite quickly. Looking at the SCHD, you get a higher yield, 3.87%, and the growth rate is a bit lower. Over 5 years, 8.78, but right now 3.57. It has a 13-year dividend growth rate, and it has increased its dividend as well. Over the past 10 years, it averaged a 3.17% dividend yield. So right now might be an interesting time to invest a little bit into it because it's been underperforming its peers. As far as VYM, it boasts a 2.51% yield. It's been growing much slower than its peers, though, 4.22. It has a longer growth streak, but it's a very low one. The dividend is still going up, not too bad, but over a 10-year period, The average is 3.1, and right now it's at the lowest point in 10 years as far as the dividend is concerned. And that might be attributed to its performance. The share price has gone up too much. So now the yield is less attractive to me. Switching to charts, VIG has been going up in a nice channel, very consistent. There's been a few opportunities in the past decade or so where you could have bought at a great price along this orange line. There was one recently also that could have been interesting. It has increased over 600% since 2009, the bottom of 2009, if you would have been lucky enough to catch it. So my plan is to build a small position into the experiment that I'm going to do, but I'm going to go very light because I'm waiting for some type of correction to go a bit heavier into this stock. SCHD is pretty far from its support, but I couldn't really trace a channel from this, so maybe I'll buy a small position as well just to watch it because it's been underperforming its peers, like I mentioned, and I'll show you that in a second. VYM is into a little bit over the middle of its channel as well, if you want. Let me just trace my lines real quick. So it's been a little bit overvalued, higher than I would like to buy it at. So I would take a small position because it might keep going for years and I would be missing the boat. Now let's take a look at the total performance, including the dividends, as if you were reinvesting them into the stock. Over the 10-year period, the VIG has been outperforming the other ones with 231% compared to 184 and 179 for its peers. Over a 5-year period, the race is pretty close, but the SCHD is lagging behind, as I was explaining. And it's the same case for over a 5-year period. So right now, VYM appears to be a bit overvalued compared to its peers. So that's why the dividend yield is so low compared to its historical tendencies. And year to date, same thing. SCHD has been quite flat. So if I was to go a bit heavier, I would go with the SCHD right now because I think it offers a better yield, and also the cycle might turn, and the stocks in SCHD might be the next heroes in the next few years. Some caveat to investing into these three. You might think you have good diversification because you are investing in a bunch of different companies at different percentages. But if you hit a crash, for instance, over here, this zone, they all crash in unison. And I expect if we look at 2020, where we had the thing we shall not name, we had a big crash that all of them crashed in unison. So that's very important to keep in mind if you think you're diversified, because of the fact that they're all US companies and seem to have high correlation, even though there are some slight variations in percentages depending on your starting point. So if you want more diversification, you could add stocks like some bonds like BND, for instance, or GLD, some gold. So you would flatten a bit your curve, but there is a price to pay for that. If you zoom out, you would have a lower performance because you added some lower performing stocks in there. Next, I want to talk about some diversification. These ETFs that we've been covering are US related. So now we're going to take a look at the international stocks and emerging markets as well. So tickers that you might want to take a look at for this are VYMI, which is the international stock of Vanguard. It's basically VYM removed from international dividend stocks. so there's no overlap. So that's a very interesting option. As you can see, over the past 10 years, it's been underperforming the other ones, but there is a but. But right before, I want to show you the other option, which is Vanguard Emerging Markets, VWO, which also has been underperforming over the past 10 years. But this is where diversification shines. If you look at the past 5 years, it's there's been a bit of a catch up from VYMI, as you can see over here. It's leading the pack right now. And if you look over 1 year, then the two best performers are VYMI and VWO. So this is something to keep in mind when you invest in stocks. Every sector has its moment to shine at some point. And this is why I try to determine which sectors have been vastly underperforming the rest of the market. And I usually start to invest into that cyclicality, into those that have been underperforming the rest of the market, because sooner or later they will have their day under the sun. Taking a look at the dividends, VYMI has a dividend yield of 3.88%, which is not too bad. Its a 5-year growth rate is 4%, which is not great, not bad, but not great. And the dividend has been somewhat consistent, and the 10-year average has been close to where we are at now. So it's not a bad position to start investing for my part anyways. And if we now take a look at VWO, we have a yield of 2.81%, dividend somewhat inconsistent. And if we take a look at the 10-year, it's at 289, so we're a little bit below that point right now, so it might be a little bit overbought at this point. Lastly, if you're looking for the Canadian equivalent to these, you have VDY, which represents VYM in the United States. You have VIDY, which is the high dividend international one, but without North America. And you have VEE, which is the emerging markets. And a little bonus extra, you have real estates, VRE, which is another popular one where you can get some decent yields if you buy at the right time. That's going to wrap it up for this video, guys. I hope you enjoyed, and I'll see you in the next one.